Hi, I'm your AFM expert tutor, Andrew Mower, and welcome along to this debrief of the question Cosmore. Now, the first thing, if you haven't yet attempted this question, please make sure you do so first. You're going to benefit so much more if you do the question before you watch me go through it. Once you've done that, great. Watch this video. I'm going to work through this big 50-mark question all on investment appraisal. So have a look at how I do the calculations, how I structure my answers, how I do those discussion parts, and really importantly, how I pick up those 10 professional marks along the way as well. So best of luck with the question and enjoy the video. So let's have a look at the breakdown of topics in Cosmore. 50 marks, as we said, and they are looking at doing some ice creams, hence the delicious image there on the right. So we're going to look at a net present value, NPV. As part of that, we need to work out the cost of capital, the WACC. We've got a bit of sensitivity analysis. We've got some discussion of risk and also a bit of discussion on capital rationing. Now, of course, in AFM, we've also got 10 professional marks. So keep an eye out for those throughout this question. I'll show you exactly what you need to do to earn those. Before we get into the question, let's think about exam timings. So for a 50-mark question, really, really important, you know how you're going to manage your time. So 50 marks works out as 98 minutes in total, that is. So if you just times it by the magic 1.95 minutes per mark across the time you have for this exam, it's 98 minutes. So the way to do this, we're going to spend the first 18 minutes of the 50-mark question planning and reading the question. So in those 18 minutes, you need to read the requirements first. So find that exhibit that has the requirements in and understand those requirements. That way you know exactly what you need to do in the task. Then you're going to plan out your answer with your headings and subheadings. Again, I'll show you how to do that, but you're going to get almost a skeleton of an answer set up before you get started with your writing. Then you can go ahead and read the exhibits and see what information they've given us. We're then going to spend 80 minutes writing up our answers and doing all the calculations, of course. So you're going to write up your answers, and that allows us 2 minutes per mark. Remember, you've got 40 marks of technical content to actually answer in this question. So it works out as exactly 2 minutes per mark. So if it's an NPV for 15 marks, you're going to spend 30 minutes doing that. And you need to be really strict with yourself. So you need to really be disciplined, keep on the time, and once you're done, move on. So here is Cosmore in the exam software. And the very first thing we're going to do then is open up the requirements and have a look at what they want us to do. Now, in the 50-mark question in AFM, there will be an element that is a report. And here it says, prepare a report to the board of directors of Cosmore. The whole question in this one is a report. Just be careful. Sometimes you might get a requirement 1 that isn't part of the report. And then it says after that, now prepare a report. So just be careful when you do your report structure. But in this one, it's the whole question, which is probably slightly easier. So part 1 is asking us to evaluate the financial acceptability of the investment in ice cream manufacturing. Sounds delicious. So we got that to start with. 13 marks for that one. Then part 2 is asking us to calculate the percentage change in revenue required for the investment to have a 0 net present value. And then also the percentage change in investment expenditure required for the investment to have a 0 net present value. So that's sensitivity analysis they're asking us to do there. But don't forget, there's also this part, evaluates whether the calculation in part 1 is more sensitive to revenue or investment expenditure. So once you've done your calculations, we then need to discuss which one is more sensitive. And it does say include tax as well. So 7 marks for that. We then have our discussion parts. Now, parts 1 and 2 are mainly calculation based. So we're going to do those in this spreadsheet. So we'll get into that a bit later, but you'll open up the spreadsheet to do those ones. But for parts 3, 4, and 5, these are more discussion based. So we'll do those in the word processor. So part 3 discusses the process for and the problems with. Now, there are 2 parts to that. You've got the process for and problems with incorporating project risk into the cost of capital of the investment in ice cream manufacturing. And then also the problems with linking risk assessment to the cost figures in the investment appraisal. So we've got 2 parts, but it's almost 3 parts: the process for and problems with, and then also the problems with linking risk assessment. So break that down into little bits. Those 9 marks suddenly become almost 3 lots of 3, which is far more manageable. Part 4, discuss the limitations of using sensitivity analysis as a basis for whether to invest in the project or not, with reference to your calculations. 7 marks for that. And then you've just got this little bit on the limitations of linear programming as a basis for choosing between investment projects in a multi-period capital rationing situation. Now, a lot of people will look at that requirement and think, oh, that's not a classic AFM thing. Most of the bits above are fairly standard AFM topics, but that one, maybe a little bit more niche. It's only 4 marks, so don't worry about it. Lots of people go into a bit of a frenzy and think, oh no, I can't do this question. You can. We can pick up loads of easy marks in this one, and we'll give that one a go and pick up some marks along the way as well. Now, of course, you've got these professional marks at the bottom here as well. In the 50 marker, you'll always get tested on all of them. So we've got communication. To earn those communication marks, we're going to do a really nice report format, which I'll show you how to do very soon. We're also going to make sure our language is very clear. All your workings are laid out beautifully. Again, exactly as I'll show you in this video. Analysis and evaluation is about using the correct data from the question, doing some good calculations, also drawing conclusions from your calculations. So for example, when we do our MPV in part 1, we are then saying whether they should or shouldn't do it. So we're drawing conclusions from the numbers that we've done. Skepticism. Now, this is one that students often struggle with. We've got to be skeptical of the information they've given us. As we'll see in the exhibits, they'll provide us with lots of information. We're just going to question it, and we're going to challenge key assumptions as we go. Now, both parts 4 and 5 are discussing limitations, and even part 3 is problems with doing that. So there is an element of skepticism built into this question. But still, when we're doing parts 1 and 2, we can drop in a few little assumptions just to be really skeptical. And then commercial acumen, another one that the examiner often says students struggle with. This is about making your answers relevant to the company that we're dealing with. Now, we haven't yet looked at Cosmore, but we'll read that soon. And we're going to understand exactly what industry they're in, what they're trying to do. So when we're making recommendations and discussing things, we're making it really relevant to the company and the industry that they're in. We're thinking about how could they improve as a business, what sort of commercial insight can we offer. Now, you don't have to be an expert in every industry, but you can make points that are specific to that industry, and that will really help you. And also make suggestions that are realistic and relevant to their situation. So there we go, we've got our requirements. Now, the very first thing we're going to do before we even read all the exhibits or anything is get this set up in a bit of an answer plan. So we're going to get this all laid out really nicely so that we can see how it's all going to look before we start getting into the exhibits. And we're going to do that in the word processor. And don't forget, you can move your screens around. There we go. So I'm going to turn all of these requirements now into a structure for my answer. And because it's a report, I'm going to do my report format as well. Now, this is a really good thing to do at the start of the 50-mark question, because you don't really need to think too much about it. All we're going to do is transfer those requirements into the answer box and just get it all structured really nicely. Summarize them a bit, get some subheadings in, and also think about our timings. So if you're a bit nervous on exam day, which is perfectly normal, by the way, it shows that you care, it's a good sign, then this is a really good thing to do at the start, because we're not really having to take in too much information. It's just a bit of a routine. So this is the very first thing I do. Once I've read the requirements, as we've already done, I'm now going to get all of those into my answer box and get it set up really nicely. Now, because this is a report, we need to think about our report format. So for a report format, we need to do to, from, and subject. So I've done to Cosmore Board of Directors. From, in this one, I just put financial manager. It doesn't really give us a title, so just put something sensible. And then I put subject proposed ice cream project. Then what we need to do is do a little introduction. Now, this can be really, really brief, just a quick overview of what the report's about. And there we go. I've just done a couple of lines. Now, the examiner recently said absolutely fine for the introduction, just to keep it very brief. So I've just said this report financially evaluates the investment in ice cream manufacturing, including its sensitivity to key variables, also discusses how risk can be incorporated and issues with using linear programming as part of capital rationing. So we're just really summarizing all of these requirements into 2 or 3 lines. Perfect. Now, the next part of your report structure, we're going to put report findings. So we need to do that. Now, that's going to be the main body of the report. So we're going to have part 1, which is the financial acceptability. So again, you can just type that in. Now, you can copy and paste from these requirements into here if you want to. I quite like just summarizing them just to keep it a little bit briefer. But what I would do is also add the timings. So remember, that's 13 marks. So do you remember I said it's 2 minutes per mark? So you're going to allow yourself 26 minutes to do that requirement. So I like putting the timings in just so you can be very strict with yourself. Then we've also got our sensitivity. So we can just type in there sensitivity. And that is 7 marks, which is 14 minutes. So we've got those bits there. And then we can put in our third part. So discussing the process for and problems with incorporating the project risk. So I've just called that incorporating risk. What I then do is set up some subheadings for this one, because we've got the process for and problems with, and then the problems with doing that bit as well. So I'd break that down again in that initial stage, just so we don't miss anything. It's very easy to miss bits in this. There we go. So I've just put those 2 bits, incorporating risk into the cost of capital, and then problems linking risk assessment with costs. So I've got those in there just so I don't miss anything. Then we've got limitations of using sensitivity analysis, which is 7 marks, so 14 minutes. And finally, we've got the limitations of linear programming in the context of capital rationing. So 4 marks is only 8 minutes for that final part. So we've got our report findings. This is where we're going to do the majority of the question. And then at the very end, once we've done all of that, we then need to do a quick conclusion, again, as part of the report format, just to summarize what we found. And what we'll then do is almost just tie into that introduction and just say whether it's going to be worth doing the project or not. So there we go. Before we've even started reading the exhibits, can you see how nice that's looking? So it's already looking really professional. We've got our to, from, and subject. We've got our introduction, which we've already done. And then we've got our report findings all set up, ready to go. And our conclusion is set up as well. So again, that's a really good task to do just in the first few minutes of the question, just to help yourself calm down a little bit, just get used to that. Again, we haven't really had to think about anything too much, but it now looks amazing, which is the main thing. Now, when we're doing this as well, remember to do all of your calculations in the spreadsheet. So this is for the discussion part in the word processor. So we're going to do all of our calculations in the spreadsheet. Parts 1 and 2 are heavily calculation based. So what you can do is just write a little note in there, just saying, please see the appendix for calculations. And then you can just copy and paste that underneath as well, just so they know that we've done all our calculations in the spreadsheet. Now, once we've done that, it might just be worth in the spreadsheet, just popping at the top, appendix. So you can just call it an appendix at the very top, just to continue that really professional looking theme. And then we can do all of our calculations in that spreadsheet shortly. Great. So we've got a beautiful looking question now, haven't we? It's all set up. Now what we need to do is read the exhibits. So I'm not going to read them all to you. You can read these yourself if you haven't read them already. But we've got a bit of background around Cosmore. So you can have a look at that, what they currently do, a bit of their background, and sort of what the question's about. That first one tells us. We've then got the investment in ice cream manufacturing. So they give us all the details that we need there to do our MPV. And we'll dig into that very soon once we get into the MPV calculation. And then you've got the other investments. This is the little bit at the end around the capital rationing and linear programming. So some limitations of that. Right, so we are all set up. We're all ready to go. Let's get stuck into the first requirement. And just a reminder, that first requirement said, evaluate the financial acceptability of the investment in ice cream manufacturing for 13 marks. So we'd have 26 minutes to do this requirement. So let's just think about what this investment actually is. So we've got Cosmore, our company, and just be careful in this one. Look, they make fruit flavored drinks. So that's what they're currently doing. They make fruit flavored drinks, but they're considering making some ice cream instead, manufacturing ice cream. This is the first time in food manufacturing. So at that point, you're thinking, this is an interesting move, isn't it? They're moving away from fruit flavored drinks. They're going into a new industry. And look, they're going to start making ice creams. So what that should shout out to you is a risk-adjusted whack. If they're changing industry, what we're probably going to need to do is do an investment appraisal question, but using someone else's information to approximate what a cost of capital is going to be for us. Because Cosmore, they make fruit flavored drinks. Their cost of capital is relevant to that. But if they're moving into a new industry, we're going to need to do some sort of risk-adjusted WACC calculation. So that's what we're going to see in this question a bit later on. Again, read all of this. So make sure you've taken all that in. Then in requirement 2, it gives us all the information. Now, a few clues in here that it's going to be an NPV. You've got things like sales, quantities, prices, all that sort of thing. Again, that looks very much like an NPV, doesn't it? So we've got all these numbers that we're going to need to use, and costs, got some inflation thing, tax allowable depreciation, all those sorts of bits, which are pretty standard. Working capital we've got in here as well. And then, look, we've got all of this information about their current structure. So we've got all of their current structure for Cosmore. And then we've got another company, Whole Co. And they're an established ice cream manufacturing company. So we are going to use them as what we call a proxy. We're going to use their information to roughly approximate what a suitable discount rate would be for this project. It then gives us things like the current risk-free rate and the market rate of return. As soon as you see those, we're thinking we're going to need to do a CAPM, so capital asset pricing model. Debt can be risk-free for both companies, which is great. Tax at 25% and so on. So we've got all our information. That's the hint as to the method we're going to need to use. They're changing industry. Now, there's no talk of their gearing changing, by the way. If there was any talk of them maybe having to take on a load of debt to do this project, then they may have to use an adjusted present value, an APV instead. But in this one, there's no talk of their capital structure changing as a result of this project. Therefore, we're not going to need to do an APV. It's just going to be a risk-adjusted WACC. So it'll be an NPV as normal, but using this new special discount rate that we're going to calculate a bit later on. So before we get into the numbers and so on, I just want to do a quick reminder how to set up an NPV. So there's a really nice template you can use for NPVs, which looks like this. And we're going to do your revenue, less costs. Then we deduct tax allowable depreciation, and that gives us your taxable profit. Take off tax and work out your tax on that taxable profit. Then you add back the TAD. The reason being it's not actually a cash flow. We've only deducted it to work out our taxable profit line and therefore work out what the tax should be on those figures. So the adding back the TAD just cancels out that tax allowable depreciation we deducted above and therefore leaves us with a nice net tax position that's correct. You then take off your investment, add back any scrap values, and you've got your working capital. And then that gives you your free cash flow at the bottom. We then need to discount the free cash flows at the company's cost of capital. You can use the NPV function to do that, or you can discount it separately each year. And then, of course, in AFM, we're going to discuss our findings. So need to get those analysis and evaluation marks and actually discuss what does that figure mean? Should we accept it? Should we not? How does it work in the context of the question? And there we go. I've just got that all set up in my spreadsheet. So again, a really good structure to know. Now, sometimes you may have to vary it a bit. For example, if there had been fixed costs and variable costs, I'd separate them out on different lines. And there may not be working capital. There might not be something else in there. Obviously, just ignore it then. But most of the time, this is going to work really nicely. And I'm going to do everything in thousands. If you look at the information they've given us, they give us everything in thousands there. So quite happy to do everything in thousands here as well. Makes a lot of sense. Then it's just a case of working through it line by line. Now, some of these are easier than others, as is always the case in these exams. And you're just going to work through it. Remember, if you get stuck and you think, oh, I can't find that number, just make it up and just keep going. Doesn't matter. Just have a quick go, keep going, because you'll pick up loads of easy marks in this one if you just keep going. Even if your number isn't perfect at the end, you could still get 12 out of 13 marks, even though your MPV is completely wrong. So just keep going. There's something called the own figure rule, whereby they carry on marking it even if your initial numbers are wrong. So let's start with sales. And in this one, actually, sales were lovely because they gave us them. Revenue, it tells us that there. And then we just need to copy those numbers down. It's 4 years. They're already inflated for us. They've already given us those. If you wanted to work it out, you can. They give us the quantities and then they give us the price of each ice cream. $5.20 in year one, rising by 5% each year. If you want to check, you can, but they are correct. So those revenue figures, we're literally just going to copy out these numbers here, the 14.3 million and all the way across, so the 18.018, etc. That's going to be our sales figure in this line. And there we go. So just copy those down. No marks for that, unfortunately, but just make sure they're in the right year. Remember, we won't make sales immediately. They will start in year one. As you can see in here, look, they start in year one. So that is the perfect timing. Now, if you want to lay this out really nicely, which I'm a big fan of, what you can do in the software is if you look at the top there, you can click on the two little zeros, the 0.00 at the top. And then if you click on this one, it then will just do everything to the nearest $1,000 and it puts the comma in. So I always think that looks a bit nicer, doesn't it? It's a lot easier to read. So anything you can do to make it easier for the markers, go for it. So that's a nice little tip just to make things look a bit nicer. Right, now we're going to do costs. Now, unfortunately, they don't give us costs. We've got quantities, so we know how many units we're going to sell, so how many ice creams we're going to sell in this situation. And then they give us the costs, so $3.80 per ice cream in year one. But then we've got a little bit of a complicated inflation thing going on because costs in real terms are going to fall by 4% in years 2 to 4, but they're also going to inflate at the same time. So we're going to have some inflation, which are at those rates just below. So that's a bit fiddly. We've got almost two inflation rates going on. They're getting cheaper in real terms because we're making more. So we're getting economies of scale, but the actual price of the cost, the value of the cost is going to increase because of inflation. So we've got to deal with both of those. So we can do that in a separate working. I definitely do that. And if you're going to do separate workings, just make sure you label them. So we're just going to call that working one. And then a little bit further down, what we want to do is I like actually just copying and pasting whatever I've put there and just leave a bit of a gap because we'll do some other workings in a sec, and then just paste that there and then just underline it. And that way it's really easy to follow because it's exactly the same wording as you've used up there. So let's get our years across the top. So we can just copy and paste that. Again, anything you can copy and paste, do so because it saves you time. So we'll put our years across there. And what I'm going to do is put in our quantities, which they tell us in the scenario. So this is the number of ice creams. So we're not making any in year 0. Year 1 is 2,750. Year 2 is 3,300. Year 3 is 4,150. And year 4 is 5,350, like so. So they're the quantities that we're planning on selling. So in terms of the cost per unit, this is going to be in real terms to start with. So I'm just going to do these in real terms. And it says it's $3.80 in real terms. I'm just going to take off the thousands actually, because in this one, we won't do thousands. So this is $3.80 and it is a cost. So I'm going to make it negative. So that is our current price. And again, as a little tip, you can always just do it to 2 decimal places. There we go. So $3.80. Now it said that that cost is going to decrease after that by 4% each year, didn't it? So it said that that is going to decrease because of economies of scale. That cost per unit is going to drop by 4%. So to do that, I'm just going to take the number on the left and times it by 1 minus 4%. In other words, times it by 96% because it's dropping by 4% each year. So just times it by 1 minus 4%. And then I can just drag that across, and that'll do those years as well. So I'm just doing the cell on the left, less 4%. So that's what the cost per ice cream is in real terms. But remember, the cost is also inflating. So what we then need to do is do the cost per unit inflated. And what it told us in the question was after that year, again, let's just go back to here. In year 2, it's going to inflate by 6%. In year 3, it's going to inflate by 8%. And then in year 4, it's going to inflate by 8% again. So what we're going to need to do is inflate that 365 figure to begin with. That one is inflating by 6%. So we're going to do that cell times by 1 plus 6%. So that's our inflated figure there, 387. Then in this year, we're going to need to take that 350. Now, what you've got to be very careful of here is that will inflate by both the 6% and the 8%. So it's going to have that 6% inflation in year 2, but also that 8% inflation in year 3. It's like compounding, isn't it? So it's inflating both years. So what we're going to need to do is times it by 1 plus 6% and times it by 1 plus 8% as well. Like so. So that'll give us our inflated cost in year 3. And then in year 4, we can have 3 things to inflate. We've got your 6%, you've got your 8% there, and then you've got another 8% in year 4. So we're going to need to take that number, the 336, and then inflate it by 1 plus 6%, then 1 plus 8%, and then by another 1 plus 8%. Now I could have just done 1 plus 8% squared. That would have done the same thing, but either way is fine. And if we do that, it comes out as 416. Okay, so we've dealt with the real term cost is dropping because of economies of scale, but because of inflation, these costs are actually increasing a bit. So then we have to deal with that as well. Now to work out the total cost, which is what we need to put into our MPV, we're then just going to do the inflated value times by the quantity. So quantity times by that inflated value, like that, and drag those across. And that'll give us our figures. And again, we can just sort out the decimal places by hitting that number. And there we go. So there are our total costs. Great. So let's get those into our MPV up here. Now, if you copy and paste those numbers, it will copy and paste the formula. So the easiest way to do this is just to do equals and then select that first one. That will then just grab that number and then you just drag those across like so. And that'll just copy those numbers from that working. Now there are 2 marks going for that. So 2 marks for getting your costs correct. Now we need to think about tax allowable depreciation. So this is working 2. So I'd always do TAD as a separate working, keeps it neat. And again, we can just copy that and we're just going to lay it out down here. And just underline it. So just make it very clear what we're doing. Now, in this question, if we look at the tax allowable depreciation rules, it says tax allowable depreciation is available on the facilities at 25% per year on a straight line basis. So quite often when we're doing these questions, it's reducing balance, but this one is straight line with a balancing allowance or charge available at the end of the 4 years. Okay. And then it says that the facilities can be sold at the end of the 4 years for 10% of the original investment. So slightly different. It's actually a bit easier than doing reducing balance. It's slightly quicker and therefore worth fewer marks, as you can imagine. So the way I always do tax allowable depreciation is to structure it like this. So I put in my year and then I put in the tax written down value, TWDV, which I'll do in thousands. So I'll put my headings in like that. We'll start from year 0, and the initial investment, it tells us, is going to be 16 million. So you've got that 16 million there. That's how much it's going to cost us initially. So we'll put that into here, but in thousands. And again, I'll just format this nicely. There we go. So in year one, we're going to get tax allowable depreciation at 25% of that. So that is going to reduce by 25%. So it's going to reduce by 4,000. So that will leave us with 12,000, like so, at the end of year one. And then in year two, it's then going to depreciate by the same, because it's straight line. And we're not just taking 25% of that now. It's just going to be the same again. So it's just going to be that 4,000 again. Again, if we do that minus that, going into year two, it's now worth 8,000. Then in year three, you're going to have the same again. Now you can do some clever copying and pasting here, by the way. And it's just going to be the same again. Another 4,000 at the end of year three. Like so. Now, be very careful in that last year, because remember, in the final year, you don't get tax allowable depreciation. You get a balancing allowance or balancing charge. So in year four, the easiest way to do this is to put your scrap value in. So put your residual value, your scrap value in at the end, and then see if we've got an allowance or a charge. Now, do you remember in this question, it said we can sell it for 10% of the original cost. So it's just going to be 10% of that 16 million. So it's going to be 1.6 million we get at the end as our scrap. So what we've then got to think is this going to be an allowance or is this going to be a charge? We've got an asset that's worth 4 million for tax purposes, and we sell it for 1.6 million. Can you see that's a loss on disposal? It's worth 4, we sell it for 1.6. It's a loss, so therefore we'll get a balancing allowance, a BA. And the balancing allowance will just be the difference between that and that. So we're going to get a balancing allowance of 2.4 million. Okay. And there we go. So slightly easier than reducing balance. It's just 4 million each year, except in the last year, you've got your balancing allowance of 2.4. Now, these are then going to go into your MPV. So these are numbers we need to put into here. There's the less TAD line. So we're going to have our 4 million, then another 4 million, and then another 4 million. Obviously, you could just type it in 4 million if you want to. And then in here, we're going to put in our balancing allowance of 2.4 million in year 4. Right, how many marks do you guess for that? Usually TAD, I'd say, is 2. In this one, it was just 1. A little bit harsh, but because it's straight line, it was a bit quicker. But now we can work out our taxable profit. Obviously, nothing going in that year 0 at this point. And then we can just do our totals. So sum of these will give us our taxable profit. And then you just drag that across. Like so. Now, in terms of the tax then, we make a taxable loss in that first year. Sometimes you can carry that forwards, but just read the requirement. In this one, at the very bottom there, any tax losses can be assumed to be set off against profits or other profits made by the company in the year the losses are incurred. So essentially, we're going to save some tax elsewhere in the business. So you just do equals minus 25% of that. We're just going to save 25% of that 150. So we're just going to get a positive saving of 38 in that one. So it's quite straightforward. And again, just drag that across. So we're just going to charge 25% tax on each of those. So we're just doing 25% of the number above. Remember, it is negative usually. It's a tax charge. In that year, it's positive because we're saving a bit of tax. We're using that loss to offset against other profits. But elsewhere, it will be negative. And that was a mark for working out your tax. So that was quite a nice little tax calculation here. Then we need to add back the TAD. So to add back the TAD, all we're going to do is just do minus that number. So remember, what we're doing is we're just cancelling that TAD out. Because it's not actually a cash flow, we're just cancelling out that line and this line. So this line here and then this line here. We're just cancelling those out because they're not actual cash flow. But by doing that, we've therefore worked out the tax on the lower profit. So we've factored in the tax savings as a result of our tax allowable depreciation. So that's great. Right, then we put in our initial investment, which we've already seen, 16 million. Remember, that goes in at year 0. So we spend that initially. And then scrap, we saw that earlier as well. That was 10% of the initial investment, but it will be positive. So it's 10% of that initial investment. So 1.6 million is going in year 4. No marks for that either. So a little bit harsh with the mark scheme in this question at times. But again, hopefully you're okay at just putting those numbers in. Right, now we need our working capital. And that was definitely worthy of a separate working. So working capital, I'd always do as a separate working. So let's put that down here. So leave a little bit of space. We can put that there. Again, underline it, make it really easy for the markers to find it. So let's see what the question said about working capital. It tells us in this third from bottom paragraph, it'll be 12% of the first year's revenue. So that's the amount we need at the start of the first year. So that's T0. We're going to need 12% of the first year's revenue. From the second to fourth years, working capital will rise by the annual rate of inflation. So we're going to need to inflate it, and then it'll be fully recoverable at the end, which is fairly standard. Okay, so that's quite nice. So we'll do our usual working capital working, and that's to have our years across the top, as always. And then we're going to do our total working capital. But remember, it has to be the incremental working capital that goes into the MPV. So in terms of the total working capital, the question told us we need 12% of the first year's sales in place at the start of the year. So we're just going to do 12% of the first year's sales, which was that number. So that gives us 1716. And then remember, it says working capital can be assumed to increase by the annual rate of inflation. Now, we need the working capital in place at the start of each year. So going into the next year, we're going to need to inflate it by 6%. The year after, we'll need to inflate it by 8%. And the year after, we'll need to inflate it by another 8%. So we're just going to do that times by 1 plus 6%. So remember, that's ready for the year 2 sales now. So we've inflated it by 6%. And now I'm going to take this and inflate it by 8%. And then that number, I'm then going to inflate by another 8%. So I'm just using those inflation figures. So I've gone 6% in that one, 8% in that one, and then another 8% in that one. Now we don't need any working capital in year 4 because we're not making any sales in year 5, so we need them in place at the start of each year. Now, these numbers don't go into your MPV. Lots of students do that by mistake, but not you. We need to do the incremental ones. So to do that, nice and easy, you just do equals minus that number. That's the amount we're going to need to invest up front to get the project up and running. Then, do you remember you need the incremental bit? We've now got 1716. Next year, we need 1819. So we need to put in the difference between those. We just need to top it up. And the easiest way to do that is just to do equals the number diagonally to the left minus the number above. And that will just tell you the amount that you need. And then you can drag that all the way across. And if we just make that a 0 at the end there, that will then even do that for the last row as well, which is great, or the last column. So you're just doing equals the number diagonally to the left minus the number above. And that's just telling us how much extra we need to put in each year. And then that last year, you release it all. So you just get that amount back. Now, if you add all of those numbers up, it should come to 0. And sure enough, it does. So that means that it's all netting off to 0, which is perfect. Lovely. So let's put those into our MPV. Again, we can just do equals and then select that one. Drag that all the way across. How many marks do you think? For doing that, it was 2. So 2 marks for getting your working capital figures, which was quite nice. Right, we're nearly there then for our free cash flows. So this is looking great. We need to add them all up. Now, you can't do a line like you can in Excel in the software, but you can just underline them. So that sort of gives the markers a clue that you're doing a total, which is good. So we're just going to add up these. Remember, only from taxable profit down because we've already included the top 3 rows. And that will give us our free cash flows. Great stuff. All right, that's it for part 1 of the Cosmore debrief. Join me for part 2, where we'll finish off the question. We're making great progress so far, so I'll see you in part 2.